How did capital flight worsen the 1997 Asian financial crisis? Imagine watching a country's economy suddenly start to unravel, not because of a single mistake, but because of a rush of money leaving the country. That's what happened during the Asian financial crisis of 1997. Countries like Thailand, Indonesia, South Korea, and Malaysia had been growing fast in the late 1980s and early 1990s. They attracted lots of foreign money because of high interest rates and fixed exchange rates tied to the US dollar. This influx of cash fueled bubbles in stocks, real estate, and credit. But these countries also borrowed heavily in foreign currencies, especially short-term loans that needed to be paid back quickly. When signs of trouble appeared, investors started to lose confidence. They began pulling their money out rapidly, which is called capital flight. This sudden exit of funds put enormous pressure on the country's currencies. Many had fixed exchange rates, meaning their currencies were pegged to the US dollar. As investors sold off local currencies, these countries had to buy back their own money to defend the peg, which drained their foreign exchange reserves. When reserves ran low, they had no choice but to let their currencies float freely. The Thai baht was the first to devalue sharply, losing more than half of its value in a short time. This devaluation made foreign debt much more expensive in local currency terms, hurting businesses and banks. As the crisis deepened, confidence plummeted further, and more money fled. This created a vicious cycle where currency depreciation led to more capital flight. The rapid outflow of money also caused banks and companies to face liquidity shortages. Many went bankrupt or had to be bailed out, leading to a sharp slowdown in economic activity. The crisis didn't stay isolated. It spread to neighboring countries as investors feared the region was unstable. This contagion effect caused a regional financial meltdown. The crisis showed how interconnected markets and investor psychology can turn small problems into a full-blown economic disaster. It also revealed the dangers of fixed exchange rate systems combined with high short-term foreign borrowing and weak financial oversight. Capital flight acted as both a symptom and a catalyst, worsening the crisis and making recovery more difficult. In response, many Asian countries introduced reforms to strengthen their financial systems, improve transparency, and reduce reliance on short-term foreign debt. The crisis changed how countries and international organizations approach economic stability and crisis prevention.